Hi, let's look at IAS 36, Impairment of Assets. IAS 36, Impairment of Assets. Now, at the end of this lecture, you should be able to define an impairment loss, list circumstances which may indicate impairment, account for impairment loss in the financial statement, explain cash generating unit, and allocate impairment loss to cash generating unit. Then, of course, you outline disclosure requirements under IAS 16, and I need to remind you that that instance you have to do the reading by yourself. So again, a quick reminder that under IAS 36, you read the disclosure requirements. So the standard sets out to set rules to ensure assets are carried at values no more than their recoverable amounts. Now, this is what brings about accounting for impairment. The entity has its financial statements and has assets in the financial statements. Assets show how much the entity has in terms of resources to use in the running of the business. Now, the entity must ensure that these assets are not carried at amounts more than what it can get if it decides to sell them. So, for example, in the financial statement, the carrying amount of the asset is 10,000. Meanwhile, if you go to the market to sell that asset, you only get 8,000. Your asset is impaired. Your asset is impaired. Your assets must not be carried at amounts which are more than how much you can get when you try to sell. And that is what we are calling the recoverable amount. We'll deal with the definitions soon. You should be able to define when the asset is impaired. The standard provides guidance on when an asset is impaired and prescribes when to reverse an impairment. Then, of course, the disclosure requirements. So these are the objective of the standard scope, what this this standard deals with. And that's how you read the standard. What does it account for and what doesn't it account for? It doesn't deal with assets that are inventories, assets that are deferred tax, assets that are employee benefits, and you are reading employee benefit at this level. Assets that are financial instruments, because financial instruments has its own impairment rules. Assets that are investment properties, and then biological assets. So these assets, their impairment do not fall under IAS 36. That is what we are talking about. IAS 36 applies to the impairment of all assets other than, or all assets apart from this in your financial statement. So it applies to PPE, it applies to intangible assets, it applies to other assets in the financial statement, but it doesn't apply to these. Okay, let's do with definition. Definitions of key terms help you to understand the terms as they relate to that standard, because the same term will mean something different in another standard. So you must always understand the key terms in a particular standard. Recoverable amounts. Recoverable amounts is the higher of an asset's net selling price and its value in use. So if you have net selling price, which is also called fair value less cost to sell, and then you have value in use, the higher of these two is called recoverable amount. If your fair value less cost to sell or your net selling price is 10,000 and your value in use is 15,000, your recoverable amount is 15,000 because it's the higher of these two. The higher. It's important. Value in use is the present value of future cash flows expected to be derived from the use of the assets. The present value of future cash flows expected to be derived from the use of the asset. Net selling price, the amount obtainable from the sale of an asset, or CGU, cash generating unit, in an arm's length transaction, less cost to dispose. Okay, so let's talk about these two, value in use and net selling price. If you have an asset, you're either going to use it or you will sell it. That's the point. If you have an asset, if an entity has an asset, it's either going to use it. And so we talk about the value in use. If they are going to use, then we are estimating how much they will get from usage. That is what we are calling value in use. And to determine your value in use, you have to estimate future cash flows from the use, and then you discount it to the present, and that will be your value in use. Now, we are talking about assets as an individual asset in the financial statement, and we are talking about asset as cash generating unit. And so either you are using the asset or the cash generation unit, and therefore the value in use is the present value of the future cash flows expected to be derived from the asset or cash generating unit and its disposal value at the end of its useful life. So that should explain value in use. The net selling price is then how much you get if you were not going to use it but rather sell it. The amount obtainable from the sale of an asset or cash generating unit in an arm's length transaction, less cost to disposal. And then cost of disposal is incremental cost directly attributable to the disposal of an asset, but excluding finance costs and income tax. So we are going through these definitions because that's what the terms we'll use under IAS 36. So you must take your time to understand them. I like to spend a lot of time on the definitions so that when I'm using them, you are not, you'll be following the explanation because you also understand. The standard is called impairment. So now let's understand impairment loss. The amount by which the carrying amount of an asset or cash generating unit exceeds its recoverable amount. Let me take that again. The amount by which the carrying amount, so it means you have carrying amount, my favorite figure, 10,000. The amount by which the carrying amount of an asset exceeds its recoverable amount. So we also have recoverable amount, 6,000. Your impairment loss will be 4,000. Why? Because impairment loss is the amount by which the carrying amount, by which this figure exceeds, by which this figure is more than the recoverable amount. This carrying amount is from the financial statement. It's from the statement of financial position. Statement of financial position, asset. And this one is the higher of value in use and net selling price. You remember that? Or fair value less cost to sell. So now when you get the higher, then it is your recoverable amount. And then you come and compare it with the carrying amount from the statement of financial position. Then you can talk about impairment loss. Good. Cash generating unit. the smallest identifiable group of assets that generates cash flow that are largely independent of cash flows from other assets or group of assets. Okay, so some assets that the entity have, they cannot generate income by themselves. For example, if you think about a hotel business, and you go to their restaurant, the stove in the restaurant is an asset, but the stove cannot generate cash flows by itself. The stove is an asset, but the stove cannot generate cash flow by itself. So if you want to know the cash flow of the stove, you must identify it among the group of assets which are used together to generate cash flows. So then we describe them as cash generating units. So you have to take the stove, the saucepans, and the meals that are cooked, and together they form the cash generating units. So it will be a group of assets, and they are grouped, and their cash flows are different from cash flows from the other assets. The smallest identifiable group of assets that generate cash flow that are largely independent. So they generate the cash flows as a group. They are identified together, and their cash flows are separated from the others. They are largely independent of cash flows from the other assets or group of assets. So in an entity, you can have cash generating unit 1, cash generating unit 2. It means the group assets that are that generate cash flows together, which are independent from others. Okay. Now this is what impairment is about. An asset is impaired if the carrying value is greater than the recoverable amount. You remember 10,000 is 6,000. So if the 10,000 carrying value or carrying amount, and this is from the statement of financial position, is greater than the recoverable amount, which is 6,000, then we talk about impaired assets. Remember how you get the recoverable amount is the higher of, okay, here is the greater or higher of the fair value less cost to sell, which you are also calling net selling price, net realizable value, and the value in use. Fair value, binding sale agreement. Binding sale agreement. Then the current market price less cost of disposal. Cost of disposal other than those recognized as liabilities are deducted. Okay, so all this is just to explain to you how to calculate impairment, and that's the most important discussion here right now. So your fair value, your value in use is the present value of estimated cash flows, and the cash flows from financing activities and income tax are excluded. They are excluded. Where the fair value less cost to sell and the value in use are greater than the carrying value of the asset, there is no impairment. We don't talk about impairment gain. All this discussion I'm having, I never defined impairment gain. I only defined impairment loss. Impairment is just about the carrying value being higher than the recoverable amount. Period. If the fair value less cost to sell and the value in use are greater than the carrying value of the asset or cash generating unit, there is no impairment. That's the end of the discussion. Now, how do you know an asset is impaired? So there are external indicators and there are internal indicators. How do you know an asset is impairment? When the market value declines, you have an asset and its value on the market is declining. It's external. The price on the market is declining. Meanwhile, you have the asset in your books as 10,000. In the market, it is 6,000. The market value declines. Negative changes in technology, market economy, or loss. So you have an asset And then there are changes in technology. It's like you have typewriter on your financial statement, and we are all using smart devices now. Or you have a YAM as your phone, and we are now using smartphone. Increases in market interest rate. Increases in market interest rate. So it means your asset is losing value because the interest rate increases. Company share price is below book value. Your share price is below book value. It's an indication that your assets are losing value, because if your assets have value, your share prices will be high. Your share prices will be high. The internal sources, internally, looking within, obsolete or physical damage, your asset is destroyed or something is wrong, or it is old typewriter. Then asset is part of a restructuring or held for disposal. If it's part of restructuring or held for disposal, it's likely that it is impaired and then worse economic performance than expected. You expect the assets to do more, but then it is not actually doing that. It's a sign that there is impairment. So if you see these signs, then you must conduct impairment test. That's the point. These signs should point you to conduct impairment test. And when you conduct the impairment test and you find out that the carrying amount of the asset is higher than the recoverable amount, then there is impairment loss, and therefore you write down the value of the asset to its recoverable amount. So, indication of impairment may also suggest the need for review and adjustment of useful life, depreciating method, and residual value. So it affects all these aspects of an asset. Now, look for an indication of impairment at each balance sheet date, like at each reporting date. So at each reporting date, you must look out for impairment. And like I said, at each reporting date, if an indication of impairment exists, then the recoverable amount of each asset should be estimated. You must estimate it and compare it with the carrying amount. Even with no indication of impairment, these assets must always be impairment tested annually. If you have an intangible asset with an indefinite useful life, you must impairment test. Intangible asset not yet available for use, you must impairment test. And goodwill acquired in a business combination. All right. When there is indication of impairment, carry out impairment review, calculate recoverable amount, write down the asset to the recoverable amount, recognize loss in income statement. Asset carried at revalued amount, first to revaluation reserve, then to income statement. This aspect is according to IAS 16. This is what you do when there is revaluation and the asset has loss in value. So it's the same. The treatment of an asset carried at revalued amount is the same. An impairment loss on an asset carried at cost is recorded in the income statement. A revalued asset is recorded initially against any revaluation as a reduction, with any remaining portion charged to expense in the income statement. Adjust depreciation for future periods. So this is still discussing the revalued, if revaluation model is being used. This still discuss the, now we are talking about impairment of CG. So all these assumes the asset is a single asset. So like a PP, a plant or equipment. So now we are talking about an asset which assets that are in group. So cash generating unit. So you deal with them as a group, not as individuals. Calculation of impairment done by comparing the carrying value of the group, the cash generating unit, to the recoverable amount of the group. So CGU, carrying value of CGU, and recoverable amount of CGU. And then when there is impairment, you allocate the impairment to the assets in the CGU. First, to assets that are obviously damaged or destroyed. So if any of the assets is damaged or destroyed and has no value, you deal with that first. And then if there is goodwill, you eliminate goodwill. And then if there is still something, an impairment loss, you allocate to the rest of the assets in the CGU pro rata. We will use figures to understand this better. Read on reversal of impairment loss and disclosure. Please read. And when I tell you to read, you read.